City Council will now come to order. Are there any members of the public wishing to comment on items within the competency of this committee, but not on today's agenda? Seeing none, I will now close public comment and go to Mr. Samario and Ms. Tara for our first item.
Thank you. We're actually going to start with the investment report, so I'm going to just turn it over to Ms. Tara.
Great, thank you. Ms. Tara.
Good afternoon, Chair Francisco and Committee Member White. I'm Jill Tara, Treasury Manager, and I'm here with the quarterly investment report for the quarter ended March 31st, 2012. It's the first calendar quarter of the year, and we saw good improvement in financial markets. Unlike typical first quarter, which sometimes post weak returns in financial markets, even though you can end the year strong, this continued the improvement we saw after the market correction at the end of last December. The Dow Jones Industrial Average was up 8.84%, the S&P 500 up 12.59%, and NASDAQ was up 18.67%, indicating strength in the technology sector. Several factors contributed to the strong results, including strong corporate earnings reports, moderate economic expansion in the technology, manufacturing sectors, as well as strong retail sales and strong auto sales. We also saw improvement in the labor market. This past quarter, the unemployment rate dropped slightly from 8.5% to 8.3%, so a little bit of improvement there. We also saw an easing of investor tensions over the European debt crisis. Greece defaulted on its debt with investor approval, and the European Central Bank pledged funding for other at-risk countries such as Spain. Spain is the hot one now, so there could be more to come on the European crisis. At its March meeting, the Federal Reserve Bank held the federal funds rate flat at 0 to 1/4%, acknowledging the moderate economic expansion over the quarter, as well as stable inflation forecasts, but indicated that with unemployment still running at 8.3%, accommodation was still needed in the economy. The Federal Reserve Bank's forecasts for the federal funds rate still hold that the rate will be held at this exceptionally low level through the end of 2014. So still expecting a long, protracted recovery. The Fed also pledged to continue Operation Twist to buy long-term securities and also continue to reinvest its maturing funds in that longer-term range to hold interest rates low in the long run and spur economic growth. Treasury yields were slightly lower over the curve, and we always look at those because the Treasury yield directly affects the yield that we can buy on the type of securities that we purchase into the portfolio. The agency bonds such as Fannie Mae's, Freddie Mac's, Federal Home Loan Bank notes, as well as Federal Farm Credit Bureau notes. We'll turn to the portfolio activity. As you can see, we had $12.5 million in agency bonds called by the issuers before the final maturity date. We had a $2 million maturity in a corporate note. That was the Harvard corporate note that was called before its final maturity, and we reinvested not only the calls and the maturities, but a portion of the LAIF balance for a total purchases over the quarter of $19 million, all in callable agency securities. For the first quarter of 2012, we earned $662,701 of interest during the quarter, corresponding to just under $2.1 million year to date. And by comparison, our prior year to date through March, we earned $2.46 million. So we're down about 15.5%, corresponding to a drop in the overall portfolio yield. The yield last year at this time was 1.922, reflecting some higher yielding securities that we held in the portfolio that were purchased before the recession. Those have since been called or matured out, and our portfolio yield a year later is 1.636. So just over 1/4% drop in the portfolio yield has resulted in about a 15.5% reduction in our interest income year to date. The good news is that the portfolio yield was down only 3.2 basis points from last quarter, indicating that at least at the exceptionally low levels, at least the yields are staying pretty stable and not declining further, again reflecting the higher maturities or higher yielding maturities that have been called out. Any questions? We'll move on to our investment yields table. Comparing our portfolio yield to some benchmarks. You can see that 4 years ago in March, the quarter ended March 2009, our overall portfolio was 3.58%. We hadn't realized the full effect of the drop in yields because, again, we were holding longer-term, higher-yielding maturities purchased before the recession. 4 years later, our portfolio yield is at 1.64. We're still significantly outperforming the benchmarks. The LAIF rate, which is the red bar up there, dropped from 0.53% last year at this time to 0.38%, but it's been holding steady at that level for several months now. Corresponding two-year Treasury note is yielding 0.33%, and that would be about the target length of maturity for a piece that we would purchase into the portfolio, so we always look at that. The 90-day T-bill is a comparison to the LAIF rate, and you can see if we were to just invest our money in some short-term T-bills, we would only be earning 0.07% versus the 0.38% we get up at LAIF. And for the benefit of the public at home, LAIF is the local agency investment fund. It's a state-run money market pool where we can send money up by 10 a.m. every day, any day, or pull it down, and so we manage our cash flow that way to capitalize on the extra yield that we get rather than keeping it at very low interest rates in our bank account with Santa Barbara Bank and Trust. Lastly, we'll look at a snapshot of the portfolio at the end of the quarter. You can see the State of California LAIF account. That is both the city LAIF account as well as the redevelopment successor agency funds held up at that state money market pool, totaled $37 million at the end of the quarter. We hold a $2 million certificate of deposit with Montecito Bank and Trust. Our federal agency notes in the 1 to 5 year range total $107.4 million, and we have a few corporate notes in the portfolio with a book value of just over $10 million. The balance on the long-term airport promissory note, the investment pool loaned the airport money for the quick turnaround facility. This long-term note was authorized by council a couple years ago, and the balance on that is just under $5.9 million. At the end of the quarter, we had $4.2 million in the money market account, roughly corresponding to the minimum compensating balance that we're required to hold there, for a total portfolio size of $166.6 million. And that concludes my report.
Thank you very much. Mr. White, any questions? And I have no questions either.
Okay.
Thank you.
Thank you.
Mr. Samario.
Okay, thank you, Mr. Chair and Mr. White. So we are going to be now talking about the fiscal year 2013 recommended budget, and as you know, we have identified topics for the Finance Committee to review. Today, we're going to be covering two areas. The first will be looking at kind of how we balance, but providing you the context for the current proposed budget on a long-term basis. So we're going to look at the multi-year forecast in a really condensed version, but just to kind of at least have you see what's it looking like for the next few years, what are the important issues, and how that balancing of that deficit we have next year that we balance to one-time measures, what's the context of that? So start with that, if you don't mind. So believe it or not, this is actually a more summarized version of, and I'm going to, you can pass those out, please. The more summarized version of the multi-year forecast, which has a lot more detail than this. And just to kind of orientate you to kind of for the benefit of the public who may be watching, we have basically 5 columns of data The first column of numbers represents last year, the final numbers, the actual results of operations in the general fund. We also show here what we're projecting in the current year, and then to the right of that is really the recommended budget. We call it submitted, but it is the recommended budget for next year, and that's what you've seen. And we've modified it slightly, and I'll go into that in a minute. And then 2014 and 15, what we're forecasting. So starting with revenues, you can see the details of some of our major tax revenues and how they're kind of, how they're going to lay out in the next few years. Next year, for example, we're assuming we're going to get about $19.5 million in sales tax revenues. And going across, you may recall some of the assumptions that we're making for our revenue growth. Essentially in 14 and 15, we're assuming a 4% growth for sales taxes. For property taxes, we're assuming it's going to be relatively flat, like a 1% growth. You'll see that we've included as a separate line item the supplemental property tax number. And those are the revenues we're going to get as a result of the RDA going away. We get almost 13%. We will get about 13% of the total tax increment revenues that ends up being distributed to all taxing agencies. And that number is just our best guess based on what we believe is going to be determined to be enforceable obligations and what are not going to be determined to be enforceable obligations. This number could change, could go up higher, depending on what the Oversight Board decides is not going to be allowable and would then be distributed to us as well. And then other taxes includes a lot of other, the bed taxes and the like. And you remember, bed taxes is the one we are assuming a 6% growth in the out years. But if you just look in total revenues, you could see that, with some modest assumptions going out, and of course with strong growth in this past year, our revenues are going to grow pretty substantially. From last year to 2015, that's $11 million of increased revenues just based on, the projections we have to date. So, we're clearly out of at least we're assuming we're going to be out of the downturn, and we're not going to have anything come up in the near future, such as we had before. So we're assuming some nominal growth in most areas, some strong growth in a few, but overall we're going to see some pretty good increases to total revenues between now and 2015. Sure.
Question here, Mr. Chair.
Sure, of course.
I didn't understand the $11 million
Yeah, if you go from the actual total revenues in 2011,
actual total revenue.
which is 100 million, 0.6,
100 million, okay.
all the way to the right, what we're forecasting by 2015.
Okay, so 11 to 15.
And over a 4-year period, I guess in 4 years of growth, we're looking at 11%, which isn't bad. On the expenditure side, you could see that the growth is sort of corresponding to that revenue growth. Last year, we ended the year spending 97.9, almost $98 million. All the way to the right, you can see that number will grow to $110 million. And I will tell you that the only, the big increases we're seeing is in 2014. If you look at salaries and benefits, it goes from 82.3 million to 85.4. That includes, that's really the increase for two reasons primarily. We know that public safety concessions expire on June of 2013, so those automatically kick in 2014 without any related or offsetting concessions. And I think it's somewhere around 5% for both police and fire that those salaries will go up. And then in 2015, we have included, actually in 14 and 15, it still includes an assumed 2% increase to non-safety employees for salary increases. So 2% in 14 and an additional 2% in 15. So that also explains part of that growth. Of course, we know that PERS rates are in that number, so we're seeing some increases in PERS rates. Not as high as we thought originally, but it's still going to be on a trending upward. So if you look at 2013, I wanted just to have you focus on what this backs out. We backed out the one-time measures that we are proposing to balance 2013. So without those, down at the bottom in red, you could see that we have essentially an unclosed deficit of $879, almost $880,000. Last year, we thought that number was $2.7 million, so it's gone down substantially. What's interesting is if you go to the right of that, for next year, that number is about almost exactly the same. So it sort of suggests to me that that is really a structural problem. About 880,000, not an insurmountable number, but it's certainly something we're going to have to address. It's possible that with an increased revenue growth beyond what we are assuming, we can close that. We saw what had happened in the last just 1 year. I will say that it came with double-digit growth in sales taxes and double-digit growth in a lot of months for bed tax. to sustain that, it may be unlikely, but it is possible we can close that substantially with maybe 7% growth in our bed tax instead of 6, for example. So that's kind of the framework for the current year. I think we're looking a lot better. There are some uncertainties out there, but I think for the most part we're doing okay in terms of closing that gap. We're making good progress. And by 15, it's even, assuming the numbers are correct in what we're projecting, that number is actually getting a little smaller. So the bottom half of what our multi-year forecast is this schedule here. This talks about, if we make, based on those assumptions, what does that mean to our reserves? And we kind of talked about this before, the fact that because our reserves are based on a percentage of the budget, that any year that we have growth in our operating budget, we're going to also have a corresponding increase to our reserve requirements. And we sometimes forget that. And for example, if you just look at 13, we are supposed to have $28 million in the bank in that year. We're going to be $8.7 million short. The growth in the requirements is going from 28.2 to 29.7 in 2015, just because our expenditures are growing or projected to grow. Which means that if we end every year in the next 2 years or 3 years balance where revenues exactly match our expenditures, we are going to fall further behind in our reserve requirements. And we, in a sense, we almost have to sort of recognize that every year we have to generate a surplus sufficient to cover the growth in our reserve requirements if we're going to have a policy that's based on a percentage basis. So, for example, in 14, we're going to see about a $500,000 growth in the reserve requirements. So we have to be able to count on and put aside $500,000 of any surplus we generate just to continue to fund our reserve requirements. And it's just one of those burdens we're going to have to recognize and plan for, because any surplus we generate in any year, we can't just spend it on other purpose. Part of it's going to have to go toward this. And by 15, you can see it goes up another almost more than $1 million. So in 15, we're going to have to find a way to come up with $1 million just to fund the increased reserve requirements, assuming the expenditures grow as we think they are, and we're still with a percentage-based reserve requirement. Does that make sense?
It makes perfect sense. So I have a question about that. At a policy level, when you see the reserves continuing to decline, even with increased revenues, might that not indicate that we need to be reducing expenditures and putting more of that into the reserves instead?
Sure, absolutely. Yeah.
That topic, I mean, that's part of our policy discussion there. But,
Sure.
When do you use reserves, and even when we use them in recessions, or we use them when we have a cutback in revenue. So how much, I mean, this is like Europe, right? I mean, the austerity, and how much do we start putting money aside when we're still in the bottom of a crunch, and how much do we use those reserves during that bottom time, because that's
Right.
what their intention was.
Right.
The fact that we sort of, that the city slipped on a banana peel 8 years ago or whatever, that's what we're stuck with in this cycle. But I still think there's some a discussion to have around accumulating reserves when we're still in a recession.
Absolutely.
Yeah.
Which will be part of our discussion sometime soon.
That's true. I mean, we obviously have competing priorities. Last time we spoke about reserve policies, you might recall that our recommendations were that, assuming we had surpluses in the future, and to the extent we had surpluses, we would allocate those monies first to address the required reserve increases if we had sufficient monies, and then second, to try to restore that negative so that we don't go further into the hole that we're starting, to close that gap, and then lastly, to put some money aside for infrastructure financing. So those are going to be competing priorities and challenges for us to get there, and we have to kind of keep that in mind.
Mr. Armstrong.
And I also want to point out, go back to the prior chart, Bob, because this, I think, makes the where we are on reserves look a little worse than it really is. Because, for example, in fiscal year 13, which we just submitted, this shows that we have an $879,000 deficit, which then makes the reserves go down. But the reality is we've already plugged that number. So that just in itself exaggerates where we're going by $879,000. And I can assure you that next year we will not propose to you a budget that has a deficit of $880,000. We will propose a balanced budget next year, even if it's with one-time sources. So this is what Bob shared with you is kind of worst-case scenario. The other thing that typically happens, if you look first at fiscal year 11 and then at fiscal year 12, try as the departments can, they're never able to spend all the money that's appropriated. And so as you see in fiscal year 11, we ended up $2.1 million in the black. Now, some of that was revenues, but some of it was with expenditures, even with the variance we build in. And then this year, as you can see, we're going to end up, we believe that we'll end up $1.3 million. We could end up better than that. So I think that it's good to look at the multi-year, but I think if we give you a balanced budget with reasonable assumptions, that we will typically end up $1 million to $2 million to the good, just because that the departments won't spend it all, the natural turnover, and revenue's doing slightly better. So I mean, I think what we showed you is kind of if we do nothing and we make no corrective action, here's where we're going to end up. My expectation actually is that we'll probably continue to, at least maintain our own or be restoring reserves, because we're not going to be proposing any conscious, use of reserves unless the council really wants to.
Okay. Thank you for that clarification. Mr. White, did you have
Another comment, and that is at least my thinking pattern won't surprise anybody in this room, but and we'll be talking about it a little bit with the pavement maintenance program this afternoon. When I see things like the pavement going down in quality, it's almost like that's another deficit. That's another, to me anyway. It may be an illiquid one, but it is. And so one of the places that and Mr. Samario mentioned it as on the list of places where surprise or excess revenues go would be, in my view, at least a strong consideration made for refilling that deficit, that infrastructure deficit. And I know you mentioned it, but that's how I'd be looking at even not refilling the reserves, the cash reserves, in such a timely way, but rather making sure that our things like our pavement is not getting sacrificed so that we have the money in the bank. We will be hurting ourselves in another way as well.
Thank you.
So with that in mind, I just wanted to remind everybody how we then close that remaining gap of $880,000. The proposed measures, we've already talked about these, but we had some residual monies in the storm disaster funds of $332,000. We are, and we talked about this, in fact, yesterday, we are getting $600,000 as a rebate from our Joint Powers Authority that helps us with our liability program. We're self-insured for a portion of our liability exposure, but we're also a part of a Joint Powers Authority where we share the risk with other agencies, including ourselves, and we pay a premium into that. And every 5 years, we're eligible to get rebates depending on what actually transpired, relative to actual claims. And so we were able to draw down from that JPA $600,000 that was available on closed-out years, and we were going to use $183,000 of that in order to transfer into the general fund to help close our gap. And then we mentioned in our capital fund, every year when we look at our capital program needs, we transfer money from the general fund into a capital fund, and that's the number you typically see every year of $500,000, $600,000, $700,000. What we're doing is just transfer those monies over, and then over a few years, those capital projects will be spent. And what we found is that over the last several years, we've accumulated savings because projects, believe it or not, actually came in under budget. And so that just falls at the bottom line of that capital fund. And so we identified this as being available. And so that's going to be used toward the next year's capital program. So we're essentially using reserves, but it's reserves accumulated in this fund from savings on other projects. And that's how we're going to be closing the gap. Any questions on that piece?
No.
Okay, so then with that, we'll go on to our revenues. You've seen a lot of this, but we're going to try to provide a little more detail on some revenues you've not seen before in terms of what our growth assumptions are for next year. So I'll turn it over to Ms. Tara.
Thank you, Chair Francisco and committee members. Jill Tara, Treasury Manager, back again with a discussion of our general fund key revenues. We'll look at historical performance for some of the major revenues, look at the revenue assumptions that are contained in the proposed budget for fiscal year 13, as well as the growth estimates. And some of these revenues, at least the what we call the big three, the sales tax, property tax, and transient occupancy tax, you've seen this before. We'll look at it in a little bit more detail. And then I'll go into some of the other revenues in some more detail and give you some information about those, including our utility users tax, franchise fees, and business license tax. And we'll finish up with a discussion of the anticipated year-end variance, which is budgeted as a revenue, but not truly a revenue. And the ones that we'll look at today, just to give you a sense of, even though we're only looking at a few of the general fund non-departmental revenues, our non-departmental revenue budget for fiscal year 13 is $80.1 million, and these revenues comprise over 90% of that. There are some other revenues in there making up less than 10%, including transfers, the one-time measures that Bob talked about, interest, which is small these days. So by looking at just a few, we'll capture the bulk of the general fund non-departmental. Starting with sales tax, you can see on the left we have historical growth rates back to fiscal year 2002, as well as the actual results of sales tax that came in for each of the years. Down at the bottom of that table on the left, you can see the average for fiscal years 2002 through 2007 was a healthy 2.3% growth rate. We looked at the pre-recession levels as we continue or expect to see continued improvement in this, especially reflected by the strong returns that we've seen in TOT. As you know, we receive sales tax on a quarterly basis from the state, 1 quarter in arrears. So when we put the budget together to estimate where we think we'll end this year and then build our budget numbers from for next year, we only had 2 quarters of actual results. You can see the first quarter of this fiscal year, we grew 8.4%, and in the December quarter, those results were received at the end of March. We grew 9.7%. That's just phenomenal growth on top of the June 30th quarter of last year with 11.1%. So we've finally seen some strong growth in that. But we have budgeted relatively conservatively for the last 2 quarters of the year because it is a major tax, and if we're wrong, a small percentage can have a big impact. We think we'll end the year at about $18.8 million, or 6.8% growth overall. And if you look over to the right, that puts us ahead of collections in fiscal year 2005. Assuming a growth rate of 4% for the 4 quarters next year, that would give us a budget of $19.5 million that we've put into the recommended budget you're looking at, and that's back at the collections of fiscal year 2006. So we're growing our way out of it, but much more slowly than some of the other revenues that we see. We'll move on to property tax. And for this year, for fiscal year 2012, we already know what the assessed roll, the property tax on the secured assessed roll is. We know that we'll come in about $22.7 million after we receive all the payments from the county. We've already received our airplane property tax of $408,000. The only areas of both concern and that we don't know how we'll end the year are the interest and the supplemental property tax, supplemental being the additional property tax on houses that are sold during the year at a higher market value than their assessed value on the books. If our assumptions do hold, and this was year-to-date information through March, if it holds, we'll end the year up about 0.5% at $22.8 million. So not nearly as strong as the 5-year average, the most recent 5-year average, but certainly better than last year, which ended the year down 1.1%. For next year, we've assumed a 1% growth in the assessed property taxes on the assessed roll, and we kept flat the airplane interest and supplemental because those don't seem to be recovering, and certainly we know that home prices are still declining in some cases. If our assumptions hold at this 1% would give us $23.1 million next year, and as Bob spoke about a few minutes ago, we've also budgeted an additional $1.5 million for the property tax that would potentially come back to the general fund. So the total budget for property tax next year is $24.6 million. On to transient occupancy tax, or TOT. This is really our strong performer, and there's a couple things that feed into this. As the economy improves, we've seen a return of both business and pleasure travel, corresponding to higher occupancy rates in the hotels, but also affecting that. You'll get what we call as a double whammy effect. As occupancy goes up, so do the room rates. So we see that this particular revenue, which is a major source of general fund unrestricted tax revenue, is highly sensitive to changes in the economy. So you will see this has recovered much more quickly than sales tax, and the growth rates are typically higher. You can see that the average growth in TOT during the pre-recession years was about 4% healthy growth. We ended the year at the end of last fiscal year 11, at 8.7% growth, putting us between the collections in 2006, 2007, but we expect strong growth to continue through the end of the year. And in fact, after our revenue estimates were put together for the budget, we got that March number in, and you can see for the end of this fiscal year, we've assumed 6% for each of the remaining months. March actually came in at 14.9%. So through March, we're at 10.1% already, and but that was the best information we had at the time. So we expect to end the year at $13.5 million, which is about a $491,000 surplus over the amended budget. And for next year, we held that 6% growth that we assume for the remainder of this fiscal year, which would put us at 14.3. And as you can see over on the left, between where we think we'll end the year this year and next year, it's growth above our best. They're both would make our best years yet in terms of TOT collection. So this is fully, this particular revenue has fully grown out of the growth that was lost during those recession years. We'll look at utility users tax. This is a 6% tax on consumers based on their utility usage. It includes telephone, cable TV, electric, natural gas, refuse, and water. And the 6% tax, 3% is credited to the general fund, which is unrestricted, and the other 3% is over in the streets fund and restricted for streets improvements and replacements. I will note that the telephone UUT and the cable UUT is at 5.75%. That was dropped according to Measure G, but both are split between the general fund and the streets fund. Over on the right, you can see that the 5-year average growth is about left is about 1.5%. We ended the year last year down 0.9%, so down almost 1%. We saw a steep decline in the cellular sector due to a change from AT&T. They stopped levying UUT on the data plans and filed a class action lawsuit for back taxes on behalf of their customers. That litigation is continuing. Telephone, being our largest sector, was down 6.7%. We also saw water down last year down 3% due to decreased consumption. So we ended the year about $6.9 million. For this year, we do expect some overall growth in the UUT. expecting to end the year at 1.8%, and that's based on year-to-date collections through March, so we have about 3/4 of the year in to analyze. The decline continues in the telephone sector. We have seen big growth. You'll see that 11.2% this year in cable TV, and that's due to a one-time payment from Cox for back UUT from some misclassified households, and so they made a big one-time payment for back UUT. You can see electric is down almost 1%. And we expect that to continue. And then water has come in very, very good for a couple of reasons. One is there was a rate increase, and also it was building on a very low consumption year last year. So if our projections hold through the last quarter of the year, we'll end this fiscal year about $76,000 short of budget. We needed 2.9% growth to meet budget, but we think we'll only get 1.8%. On to next year, we looked at the historical performance for each of the sectors, and the average historical performance in terms of growth for each of the sectors. We expect the telephone to continue to decline, with cellular staying flat, but landlines decreasing 1.3% as more people turn off their landlines and migrate to cellular. In fact, I read an article that at some point Verizon has pledged to stop even offering landlines, so the way of the future is wireless. We're expecting a 2.5% growth in cable TV. That's a little bit less than the growth assumption on the base UUT growth in that sector because of that large one-time payment this year. And you can see the rest of it, gas and electric estimated at 1% for next year, and refuse and water 2%. That would give us an overall 0.9%, which is still less than our 5-year average, with revenue estimated next year at $7.1 million. We'll move on to franchise fees. Franchise fees are charged to utility providers for their use of the public right-of-way in the city in providing their service. Electric, natural gas, they utilize, as well as cable, space underneath our streets and sidewalks, and refuse, uses the city streets in order to pick up the trash. The electric, between the two different franchise fees, is a total of 2%, as well as 2% on the natural gas and refuse. And the cable TV franchise fee is set at 5% of gross sales from our cable provider here. The 5-year average is 2.1%, and we've seen those go down from some of the previous years before the recession, in both UUT and franchise fees due to higher rates, higher prices, utility prices, as well as just lower household income. We've seen those not grow as strong as one might expect, even though some of them are essential services that households use. We still saw people cutting back where they could in their household budget. Last year, we ended the year up 3.8%, and that's primarily due to the strong growth in natural gas. And we do get anomalies in this particular franchise fee by nature of the way that the franchise agreement lays out that they pay us. They pay us on an estimate based on the previous year's actual amounts due, and they true it up in March of each year. So in fiscal year 11, they had under-advanced us for 12 months, and at the end of the year, we received a big cleanup payment, which caused the growth to be 15.8%. In the previous year, in fiscal year 10, they had over-advanced us, and we didn't receive any payments in the last 5 months of the fiscal year, which then caused us to come in well under budget. So this one is particularly difficult to estimate, and we usually estimate conservatively on this. For next year, looking at the historical growth in each of the sectors, we expect electricity to decline 3.2% overall. Natural gas, we expect some increase, assuming keeping the payments flat from what we're being advanced right now. refuse up a little bit, and you'll see cable TV up 8.6% this fiscal year. And again, that's the other half of that one-time payment that we received from Cox for the misclassified households, and there was UUT due on that amount. For next year, moderate increases expected with the exception of cable. And again, that we assumed 1.5% increase in the base cable TV franchise fee going up, but that wasn't enough to compensate for that huge one-time payment that we received this year, or large one-time payment. It wasn't huge. We expect next year to grow overall down 1.7% at $3.5 million.
Of course, Mr. White.
Thank you. I'm not understanding the reason that the electric is going down.
It's based on our year-to-date growth through March. It's down this year, presumably because of lower consumption
Just
and
lower consumption.
flat
Amazing.
utility prices, yes.
Okay.
We've kept it flat for next year.
I had questions, Mr. Chair.
Ms. Murillo.
First of all, I'm sorry I was tardy. I was reading the integrated pest management report, and
Don't sleep.
time got away from me. No, it was fascinating. Terrible. In terms of these franchise, so I apologize for being late. Franchise fees. So the trash hauling company is now hauling on our streets into their processing plant more refuse from Goleta and the unincorporated areas, right? Because they took over more territory in those areas. Can we ask for more money because they're processing more trash using our streets?
I'll let Mr. Samario answer.
Or maybe I'm just...
I don't believe that our current franchise agreement with the hauler specifies that they need to pay us any franchise fees when they haul other jurisdictions' trash to their processing facility on here. And I
Which is
know-
maybe my suggestion is we could look at that in our negotiations with them in the new contract. Okay, thank you. And then you say Cox had some misclassified houses. I did hear a little bit about that. Is there any way to audit to make sure that their other franchises are not missing some houses and paying us what we deserve?
That's a great question. Yes, our plan is to do a geographic audit of their database to ensure. I know that the households, the 755 households that they had found in their database that were misclassified, they assured us that they've been corrected on a go-forward basis. But we do feel a responsibility to go in and take a look and just ensure that everyone in the city is coded as a city resident so that the revenue goes to us and not to the county or Goleta or Carpinteria. So we will be looking at that.
And then I had a thought in the TOT area. So there's a couple of hotels that I think are going to be built. Does that mean we'll have more TOT from them, or is that just more competition among the hotels for the business? And maybe that's kind of a weird question for my finance people, but...
No, I think it depends. I mean, if occupancies continue to rise, then you'll see overflow go to the new hotel. But to a certain extent, the hotel will draw from the existing hotels, particularly if they're high-end luxury. So it really depends and remains to be seen, and that's why we don't do a lot of forecasting for new hotels or reopening. One, because construction schedules can be significantly delayed, and two, because we're not sure of that impact of how much they're going to bleed from the existing hotels here.
And I could just add, we do have Al Encanto coming on board relatively soon, so with their room rates and the nature of that hotel, we think that we overall will see an increase. We can't imagine them pulling away from smaller places, so their competition isn't that great. People who want to pay $400 for a night stay, they're not going to pull away from others necessarily. We're probably going to see a net increase, we believe, at least on that hotel. But it generally depends on what kind of hotels are being added.
I sure miss their Sunday brunch. I really look forward to them coming back online. And then in terms of the property tax, you say additional property tax from RDA elimination, 1.5 million. Is there's some uncertainty about that? What do we know?
There is uncertainty as to the exact amount. The property tax increment that went to the RDA was around $20 million a year. And to the extent that the Oversight Committee approves the debt service and capital projects that will be allowed to continue with the RDA funding, increment funding, we'll get that, but the rest will go back to the pool to be allocated among the jurisdictions. We don't know exactly how much that the Oversight Committee is going to approve, and therefore we've put in $1.5 million. We get back roughly 13% of what would be put back into the property tax pool to be allocated on the normal basis, if you will. So there is some uncertainty. It could go up if fewer of our capital projects that we've put on our enforceable obligations list are approved. Then that would increase the amount to the pool and therefore increase the 13% that would go to the general fund. And of course, that 1.5 million is going to roughly corresponds to either costs that have been added to the general fund or other costs that we haven't anticipated yet for the elimination of the RDA. Will still have costs associated with it, and those costs will be shifted to and borne by the general fund. So it's not necessarily all free new money because we do have substantial costs that have been added back to the general fund.
Thank you.
Mr. White.
Thank you. You've discussed in recent months the increase, as I recall, in auditing of some element. Was it TOT that you were proposing to audit? Does that increase in auditing spill over to these other elements? Could you just talk about that a little bit? Thank you.
Sure. We're auditing hotels for TOT. We've reinstated that program. In the current fiscal year, the council approved an additional $50,000 to restore some of our audit programs that were eliminated during the cuts during the recession. So we're doing hotel audits. We'll do 3 to 5 per year and restore that program. As well as locating unidentified and non-compliant vacation rentals. Then we're also doing a comprehensive business license audit to ensure a level playing field for all the businesses in the city. Right now, we haven't factored anything in for any revenue for audit. It was expected that, we would recover at least the cost of $50,000, so that's in there. But anything above that, we just haven't estimated because at this point we're still kicking off the programs and we haven't realized any revenue as of yet, and we're 3/4 of the way through the fiscal year and just too difficult to bank on at this point. But we could always come back as a mid-year adjustment next year and increase the revenues to reflect that additional revenue as it comes in. It could be substantial.
And on these other utilities, or not other utilities, but on the utilities, has that been audited in the past? Is that one of those things like the hotel, which is ebbed and flowed as far as having audits or not having audits?
We do have a regular utility users tax audit program. We contract with Muni Services, who does audit programs for a number of cities across the state. They go into providers and do site-specific audits, which means they take your city's records and look at them. And then even if we're not selected as one of the city-specific audits, we will benefit because if they discover substantial misreporting for other cities, then they'll go in and ask them to open the records and true up the payments to the other jurisdictions. So we do benefit from that. It runs around $50,000 a year for that audit program, and it's generated 5-10 times that. Yes,
yeah.
yes, it's more than paid for itself.
Okay. Thank you, Mr. Chair.
Mm-hmm.
The last The last non-departmental revenue we'll look at is business license tax, and it's one of the smaller revenues, right around $2 million a year. I often don't bring it, but it's interesting for you to look at because I put on here the number of licensed businesses so that you can see the impact of the recession on our own local economy. You can see that a number of licensed businesses in fiscal year 2010 declined 4.5%, and we saw a lot of those businesses that were maybe new or barely hanging on. Unfortunately, the recession hit, and when sales dropped, it really had an effect on it. Continued to decline in 2010 and 2011, and based on the renewals that have gone out for March, through March, as well as the new licensed businesses that we tracked, we expect the number of licensed businesses will be down about 1.1% this year, and that the revenue will be down 0.4%. So we'll end the year just under $2.2 million back to the level in fiscal year 2006. And next year we've budgeted a 1% as we've seen TOT come back so strong and encouraging results in our sales tax. We expect improvement overall in the local economy, and then with the licensed businesses to go up just under 1% to about 14,500. So I thought that was interesting to look at, as well as you look at the 5-year average over the recession years, down 0.1%, so basically flat through the recession. So. Anticipated year-end variance? We'll finish up with a discussion of the anticipated year-end variance, which is budgeted in non-departmental general fund revenues. And we haven't gone through any sort of detail like this in a while. It's a revenue that's budgeted, and it's purely a budget balancing measure. So we put a plug in. Mr. Armstrong referred to this earlier. We put a plug in because we know no matter what we do, certainly before the recession, if you look at the years before the double line, we would end the year with revenues above budget and expenditures below budget. And it was roughly about, 2.5%. And so when we needed to trim the general fund and bring our budget into balance due to increasing costs, and then later after the recession, significantly declining revenues, we put that in. And that number in the anticipated year-end variance, using it as a budget balancing measure means that's less costs we had to cut from the general fund in an effort to preserve all the services and the staffing levels that we could. What would be the worst case is to make another $2.25 million of $2.25 million in cuts, and then end the year above budget. And then you've cut services to the public, and perhaps people may have lost their jobs unnecessarily when you ended up the year better than you would anyway. So certainly in the first few years we started using this budget balancing tool. It was a flat 2.25% of the operating budget, and that was achieved. And then in fiscal year 2010, as budgets had been trimmed significantly in departments and revenues were still significantly declining, we budgeted less in that line item at a flat $1 million, realizing that we weren't going to receive realize any revenue surpluses by the end of the year. And departments had cut their budgets and trimmed back so much, they weren't so likely to come in under budget on the expenditure side as they had in the past. In addition, in 2010 and 2011, we were negotiating with all the units, the different labor units in the city, and knew that we could expect some anticipated labor concessions. We didn't know exactly how they'd come in or which department. So we put those in as well. As we have balanced the budget this year, or for 2013, with a few one-time measures, as Mr. Samario discussed earlier, we budgeted this year at $1.2 million and next year at $1.2 million, just a flat figure, and aren't expecting any labor concessions would be necessary this year. So are there any questions?
Thank you very much. Any questions from the committee members? No.
Okay.
Thank you. Anything else, Mr. Samario?
I think next week we're going to be covering the impacts of the RDA dissolution. We're also going to, kind of on a separate track, we're going to be talking about is it the third quarter, not yet, third quarter review? The fees, yeah, we're going to be talking about fees as well. So that's for the general fund.
Very good.
That's what's on tap. for
Looking
next week.
forward to it.
All right, thank you.
Meeting adjourned.